So let's move on to what's management focused on. As managers, what are we doing to ensure the best interests of the investors are maintained? It's important that we manage assets well. It's important that we grow the cash flow. It's important that we use debt wisely. And this is just reinforcing some of the things that John and I weren't comparing notes when we were preparing, but we're talking off the same sheet here. Managing debt wisely. Carefully managing risk, understanding where that risk is, and trying to take the sting out of potential risks. There's some things that are outside of our control. John talked about cap rates and interest rates. There's a lot of things that are within our control. So what are we doing to carefully manage that risk? Treating investor capital like our own. It's our money. We're looking after our money. We all benefit from having that capital in together. But you got to believe that I and my staff, and we've got a great team of people, which I'll touch on here in a sec, but the people that are invested are my friends, they're my partners, they're my parents, they're my kids. So we're really looking after capital and making sure that we're treating it like our own. And adding value to investments. You know, what can we do to add value so that beyond just collecting the rents, we're generating some value? Let me just give you a short history for those of you that haven't been with us since we started investing in real estate in 2000. The first 5 years, John talked about that first investment, single purpose, limited partnerships. We'd identify an asset, we'd round up some capital, we'd invest it, and you were stuck in that investment, that single investment, until it was time to sell. By the time we got to 2005, we said, I think there's a better way to do this. How do we get some diversification? What about people that need to sell and want to get their money out? Can we create something? So in 2005, we created SPIRE Limited Partnership. If you go from 2005 to 2010, and that was actually the last time I spoke at a real estate seminar, was in 2010. At that time, we'd created SPIRE US. We were starting to invest in the US market. We had total assets between SPIRE US and SPIRE LP of just over $200 million. And then we look at the period, the last 2 years, 2012, 2013. That group of people there is the incredible team that we've assembled. We have got a really smart team. I am privileged to work with a group of people in asset management, in finance, in acquisitions that are the best in the business. So I've got great talent on the team and I just see myself really as the steward and the gatekeeper. Looking after clients' money, making sure that it's well looked after, making sure that we're buying assets at the right kind of price, making sure that we're managing the risk. But what have we done in the last couple of years? We've acquired in the Canadian just under 150 million of assets. In the US, 330 million of assets. So if we're looking today, total between the two funds, over 750 million and 120 million of properties that are under contract, 6 properties. And I'm going to touch on some properties here in a sec. So just kind of, I like directional arrows. Company profile, since 2000 to the present, we're now focused and full-time. We've got great experience, we've got good bench strength, we've got an excellent track record and reputation, both as buyers of real estate and looking after investors' capital and providing steady, stable returns. In terms of risk profile, one of the things that's happened since 2000, we've moved down the risk spectrum. We're focused on cash flowing assets in major markets, larger institutional grade assets. So if we get into a period of time where there is a downturn, it's those kind of assets that are not going to be hit quite as hard as if you're sitting out in a small market with a rural asset where there's not the selection of tenants. Those sort of things are going to have an impact on the cap rate and the value of your investments. Let me give you a couple stories. And if I had a lot more time, I could tell you lots of stories because we've got over 60 properties in our portfolio and each of them has a story. I've chosen this one because this is an asset that we acquired back in 2006. Steinbach, Manitoba. We wouldn't buy an asset in Steinbach, Manitoba, not because I don't like Steinbach, but because it's a small market and there's additional risks in small markets. We purchased this asset for $18 million, a 9 cap. Back in 2006, that's what cap rates were trading at. And remember that because we're going to see what happens as we buy assets in subsequent years. The value add. What did management do that benefited the investors with this particular asset? When we bought the asset, Wal-Mart had been talking about coming into the marketplace. We acquired the asset. We heard that Wal-Mart was again thinking about coming to town. The decision, do we get Wal-Mart onto our property or do we let them go down the street? We decided we wanted to have them on our property because that was going to be in the best interest of our property. So we brought Wal-Mart onto the site by selling them a piece of property. They built a store. We had to take down a portion of our property to create the sight lines for them. As a result of bringing Wal-Mart onto the property, we were able to attract higher caliber tenants and get longer term tenancies. Boston Pizza, Sport Check, Marks are a couple examples. And the end result of that was that we lengthened tenant maturities, improving the caliber of the tenants and the length of term of the tenancies brings the cap rate down. So regardless of the fact that cap rates have been coming down, improving the quality of the asset drives the cap rate down. We improve the stability and strength of the cash flow and the value of that asset at last appraisal, and we appraise all of our assets, third-party appraisals each year. Last appraisal on this asset was $31.1 million. The gain's not that total amount because we had to invest capital, and it's important to note if this had been bought in a single-purpose limited partnership, we'd have had a real hard time going to the partners and saying, you've got to cash up some extra money because we've got to bring Wal-Mart to the site and we've got to do some development and you're going to have to put in some extra money. By putting it into a pool, we have the capital available to do that value add to enhance the value on behalf of our investors. Another example, this is called the Redo Building. It's right across from where the Seahawks are playing tonight, and don't tell me the score. We purchased this asset in 2010 for $14.5 million. Notice the cap rate, a little bit lower than the last, a little bit larger market, but it was at the time when the Seattle market was just starting to recover. What we really liked about this asset was that it was a completely rebuilt property, so it was as new in an area of Seattle that we felt was going to recover better than the overall market economy. It had a tenant, Starbucks, for 3 of the 4 floors. Elysian Pub was the ground floor tenant, and Starbucks had moved out. They had sublet the property, and they were on the hook with the covenant guaranteeing the rents, which at the time were above market rents, through to 2014. The lease management story where we added value for our investors is we worked ahead of the lease termination to replace those tenants with long-term tenants. That was completed just this year. Starbucks comes off in 2014. We've got them off the covenant. We've got new tenants long-term, and the appraisal that we had last year predicted a certain rental rate. We exceeded that rental rate, so the result is cash flow was uninterrupted because we kept the occupancy up, which is a high value for us. Value enhancement and higher rents. We maintained constant distributions. And as a result of what we were able to accomplish through our asset management team, the appraisal came in this year at $17.6 million, which is $2.1 million up from a year ago as a result of those value enhancements.